Hello, dear students. My name is Shanawaz Ahmed, and today we are going to discuss a concept which is covered under IFRS 9 financial instrument, and we'll be discussing about how to treat financial assets. What financial asset we are discussing today? That is investment in shares. So, if you are investing in the ordinary shares of any company, then as per the business model, either it can be classified as the FVTPL, that is fair value through profit and loss, or fair value through OCI. So if that investment is being classified as fair value through profit and loss, then its accounting treatment would be like it, it is to be initially measured at its fair value, that is the price paid to acquire those shares. If there is any transaction cost incurred on the acquisition of shares, the accounting treatment of that transaction cost is to charge this in profit and loss account as an expense. Remember that transaction cost will not be recognized as an asset. It is not to be added into the cost of the investment. And subsequently, if this is the case, that is fair value through profit and loss, then its subsequent measurement, that is at the reporting date, the same financial asset is to be measured at again the fair value, and that fair value is the market value at the reporting date. So in this scenario, if share price is being increased, then you have to recognize gain on financial asset, and if share price is being reduced or decreased, then there is a loss on financial asset. So if there is any gain on financial asset, that gain is classified in profit and loss account. You have to report it in profit and loss account as a gain, realized gain, or if there is any loss, again that is to be recognized in profit and loss account. So the treatment is like that. If the classification is fair value through profit and loss, it is to be valued at fair value both at initial measurement and at subsequent measurement, and gain or loss is to be recognized in profit and loss account. But as far as the other category is concerned, if your investment is being classified as FVTOCI, that is fair value through other comprehensive income, then initial measurement is based on fair value, again the price paid. The only difference is that the transaction cost is now capitalized rather than charged in profit and loss account as we did in fair value through profit and loss. So whatever we have paid to acquire those shares, we will add the transaction cost into the acquisition cost, and that becomes the fair value. For example, if you purchase 10,000 ordinary shares at a rate of 2, then the fair value is 20,000. And if we have paid 500 transaction cost, then it's 20500. And that is the amount that is to be capitalized. But subsequently, when we report it in balance sheet, subsequent measurement is based on fair value. So both the type of investment, that is FVTPL and FVTOCI, the common thing is that these both are measured at fair value. But as far as the change is concerned, if there is any increase in fair value, so increase in fair value, that is gain, is to be considered as unrealized gain, and you have to report this gain, or decrease in fair value, that is considered as loss. These gain or loss is to be considered in, is to be reported in other comprehensive income rather than in profit and loss account. So the category defines where to recognize gain or loss. If it is a FVTPL category, gain or loss is to be reported in profit and loss account. And if it's a fair value through OCI category, then the gain or loss is to be recognized in other comprehensive income.